Now it's above, and if you're right, that inflation rate will keep going down, which means it will go below the green line, which is the Fed funds rate, if everything else stays the same. This means that Fed policy, or real rates as measured by real rates, is very tight. People are still arguing about where the Federal Reserve should go with its monetary policy and what that means for the economy and financial markets. Cathie Wood, founder and CEO of ARK Invest, has been very negative about the US economy. A lot of well-known experts, like economist and former Treasury Secretary Larry Summers, have said things about the Fed's choice to lower its policy rate by 50 basis points instead of the 25 basis points that was expected. Summers says that the Fed is to blame for the better than expected September jobs report and that things could quickly get out of hand if the right steps are not taken. Summers and others think that the US economy is slowing down, but W is sure that it is cooling down faster than needed to avoid a serious downturn that would put the whole economy into a recession. Cuts may need to be made right away. Thank you for watching this video. If you want to see more like it, please like the video, subscribe to the channel, and turn on post alerts. Policy on money. This shows the percent change from one year to the next between the Fed funds rate and the total CPI. As you can see, this chart has been important to me since the beginning of my work. That's the Fed funds rate shown by the green line. It went above that line in the early days, in the late 1970s and early 1980s. The purple line, which shows the CPI inflation rate, and stuck above it until the tech and telecom bust. Since then has been at or below the rate of inflation until not long ago. It's now above. And if we're right that inflation rate will keep going down, this means that all other things being equal, it will go further and further and further below the green line, which is the Fed funds rate. This means that Fed policy, or real rates as measured by real rates, is very tight. I've heard that many economists, forecasters, and strategists are saying, oh no, after today's jobs report, which we'll talk about in a moment. They said that the 50 basis point cut was way too much. This chart would say, no way, that's way too much. If the inflation rate keeps going down until it hits zero or below zero, which we think it will, monetary policy will get tighter. We also think that the economy will be under a lot of stress. That's why we think the Fed funds rate will keep going down. I saw Governor Goolsbee in Chicago, and he confirmed that the path is down. And that's interesting because what's the point if the Fed tells us that rates are going down and will keep going down? People want to wait and see how low rates stay. The same goes for costs. People are more likely to say, okay, let me see how low is low when prices are going down and savings are going up. In the coming months, we may still see growth that is surprisingly low. We'll talk more about this in a moment. For now, I'll just go through these numbers. Here are some charts that show how people feel about buying things. I go through a lot of months, so I wanted to give you an update before I get into the real list of economic data from the last month. But this is the Conference Board Consumer Sentiment Index. The green line shows the Conference Board's Consumer Confidence Index, and the red line shows the University of Michigan's. If you look at the green line, the Michigan poll, it shows inflation more than anything else. On the other hand, the Conference Board's line shows employment more. Based on the University of Michigan survey, you can see that lower inflation has made people feel better. However, this amount is still very low compared to the past. According to the most current data from the US Labor Department, the US economy added 254,000 jobs last month, and the unemployment rate dropped to 4.1%. Cathie also talked about the September jobs report that was just released. Experts think the report is a big boost for a job market that has been showing signs of weakness. This is especially true since it came in above experts' expectations of 140,000 jobs and a stable 4.2% unemployment rate. However, some people, like Summers, are unhappy about how strong the job market is. Cathie says that the report's results are still a bit mixed and that some parts of the economy are still showing signs of weakness. Here are some more video clips from the movie. Cathie is most worried about the industrial sector, which she says should be showing more signs of getting better if we want to avoid a slump in 2025. In other words, the buyer is not that hopeful when looking at the past. On the other hand, the Conference Board had been seeing a lot better in terms of past because employment had held up so well, at least headline employment. But now we're seeing some later, in fact, many labor signs are going down, and the Conference Board is also starting to break down. I don't think the most recent month is on this list, and it went down a fair bit. It may have reached 98. Here might be a good time to look at the report on jobs that came out today. It was much better than I thought it would be, but there were still gives and takes. In general, I'd say stronger than expected. We had, I think, 254 non-farm payrolls. They had gained 254,000. It was thought that about 150,000 would show up, but 72,000 more have in the last 2 months. It's good to make changes that go up. Well, changes going down had been going on for a long time. This is a change and we need to pay attention to it. As for the strong signs, I would say they were mostly in healthcare, education, and government. Whenever you look at cyclical signs, they are still very weak. There you have it, non-farm wages. In fact, the jobless rate went down from 4.2% to 4.1%, which is what the news story said. A lot of people thought it would go up. It didn't. The average hourly wage was also a bit higher. 0.4% from one month to the next. The expected value was 0.3. In other words, hourly wages are rising by an average of 4% per year. At this point, it looks like output is between 2.5% and 3%. That means that if the average hourly wage is 4% and output is 2.5% to 3%, then the real inflation rate is probably between 1% and 2%. That's good. When work gets done better, pay should go up. Some of the wealth is being shared by businesses. The rate of unemployment. Making things was down and temporary help was down. Temporary help is a leading sign, but it hasn't been very good at its job for a long time because it has been going down. The number of hours worked went down by about 3%, which makes some of the very good numbers less impressive. And if you looked at this week's ISM service report, employment was surprisingly low, just like it was in the factory part of that report. So once more, there are mixed signals. For the first week-to-week claims, they have been lower than expected, which was a surprise. This week there were jolts, so job openings that were higher than expected after going down pretty sharply. That was pretty cool. And I think the Challenger layoff survey was the only other factor that had to do with work. That went up 53% from one year to the next. We know there are cuts because we read about them in the news. They're up 53% from last year to this year. Just to give you an idea of what's been going on in the world of economic data over the last month, I'm going to separate things. Also, experts at JP Morgan are optimistic about the Bitcoin market in October because Bitcoin has been doing well. We know that the past doesn't always predict the future, but we think that the fact that October is becoming more well-known will change how people act, making it a good month for Bitcoin. The recent announcement and forecasts of a rate cut by the Federal Reserve were seen as important events that could help the cryptocurrency market do well this month. The study also looked at what we could do to make a difference. The spot Bitcoin ETF from BlackRock can now be bought and sold by options buyers. Analysts said that buyers can now act on the ETF and change how liquid the underlying asset is in a wider range of ways. This might make the market more stable and liquid outside of Bitcoin and spot Bitcoin ETFs. In the end, the analysts said we continue to see the crypto ecosystem being inherently more sensitive to macro factors. Thanks for seeing.